We'll get rolling. Welcome everyone to this month's installment of the Intentional Success webinar. Today, we're going to talk about, should you be quietly plotting your exit strategy? I'm going to share with you what successful entrepreneurs know about succession planning and exit strategy, how it applies to your business, and take some of the mystery out of this and eliminate some of the voodoo and some of the negative connotations of exit strategy so that we're all a little bit more comfortable with it. And it will help you move forward, and you'll understand completely what I'm talking about as soon as I get rolling here. For those of you who are new, I am Tom Stimson. I am president of the Stimson Group. I'm a business consultant. I advise companies primarily in the professional live event space and the ancillary businesses that support it. And I have spent quite a bit of time working in the kind of the M&A world, the mergers and acquisitions world in the background. I don't talk about it much in my practice because most of the things that we do have to be kept a little bit on the down low, have to be kept quiet for obvious reasons. But I have sold my own business before. I have worked as an employee, a senior executive in a company that was sold twice. Obviously, many of my clients have sold their businesses. Many of them have bought businesses. I've done the due diligence on behalf of private equity investors on the businesses. I've helped broker some sales back in the day. So I've got a lot of time in this space, though it doesn't mean I know everything, but I know a lot about what you need to know right now, where you're sitting, as you think about, what is my future? Where is this all leading to? What am I going to do next, and what your priorities should be? So this is, of course, being recorded. Thank you very much for that. And I will be able to post a recording later today. Questions at any time, feel free to use the Q&A box to post a question. I'm happy to take a stab at them. If you want to chat, say hello to everybody, let them know where you're hailing from. It's always nice to see where people are calling in from, and do that. So if you have not had a conversation with me, or even if you have, and it's time to talk about something going forward, check out the Let's Talk link on my website, trstimson.com/let's-talk, and let's have a conversation. There's nothing that we can't talk about for a few minutes and figure out what the next conversation needs to be. If you're having trouble moving forward, if you feel that there's obstacles in your way, or if you're doing well and you want to continue to do well, it doesn't matter what it is. I'm somebody that you can talk to about that stuff privately. And if I can help you, if we can help each other, then we can talk about that as well. Pandemic update. Wasn't planning on doing one, but then I remembered that this webinar is the 2-year anniversary of the Survival Series webinars at the beginning of the pandemic. The story is I had something scheduled for March. I'm sure it was on marketing because my May workshop, Jumpstart workshop, was going to be on marketing. And sometime in that, first few days of March, I could see the handwriting on the wall that we weren't going to have a workshop, and that my webinar topic was going to be a little tone deaf if I didn't speak to the pandemic and what was happening and help people understand what was going to go on. And it was a big turning point. It was a big turning point for me. I know it was for you. And we spent the next 20 some odd weeks doing pandemic webinars, helping people cope, transition, pivot, deal with all the things that were going on, their EIDL loans and PPP money and, whatever was going on in their country about pandemic subsidies in the government, and how you're going to run your business when 100% of your business just vaporized almost overnight. So who would have thought that 2 years ago we would be where we are today? And yes, we're still in the pandemic and there are still issues going on. But I deal with a lot of companies who are thriving and are doing extremely well. And in fact, better than they were before the pandemic. And this is not something that was on anybody's radar map back then. We've had some great revelations and epiphanies during this very troubling time. And I think the net result is that our industry has benefited from what we have learned. So pandemic update, yes, the US is effectively open. Other countries I see will fall in behind us. I mean, we're a little bit ahead of the curve, but for all intents and purposes, there's really no reason your clients can't hold an in-person event if they want to. The responsibility for mitigation is shifting to the attendee and away from the organizer. That doesn't mean that responsible organizers still won't take some responsibility for making suggestions and maybe controlling density and some things like that. This means that demand for your services should become a little bit more steady, which sounds like a good thing, but remember the danger of that is you could fall back into your pre-pandemic model of commoditization and trying to grow by taking every job that's coming your way, because that's kind of what we've had to do the past 2 years. But demand is going to be steady, which means that you've got to exercise your no muscle and learn to say no more confidently and more prudently for the benefit of your customers that you have chosen to say yes to. So I do recommend cautious optimism. I think your risk of investing for the future is down. And I think that's the right time for us to start talking about this topic that's been in the wings for the past couple of years, which is exit strategies. So exit strategy is not something we talk a lot about. And the main reason is because I know that it makes you nervous for your employees to think that you are thinking about that. You know me, I believe in transparency in just most things. And I think, the more we communicate with ourselves about what we want for our future, the easier it will be for us to communicate with our employees about what's important and why you're doing all of this. Thinking about exit strategies that mean that you're planning on selling the business and that, Gordon Gekko is going to swoop in and take over the company and liquidate everything and fire all the employees. But in some employees' minds, that's kind of the thing that starts to spin up for them because they remember some things in the past, and I'll talk about those. So I'm a big advocate of getting out ahead of it, get in front of these topics, and let them know how it applies to what we're doing here today. What's this thing that we're working on? What's this business goal or tactic that we're trying to refine? And how does that tie into the long-range goals of having more opportunities and more choices? So this webinar is really important because, and again, this is 40 years of experience in the industry. We've had exit strategy and succession strategy all wrong. I mean, it's been a mess, and I've lived through it. Many of you have lived through it, those of you who have the gray hairs. And we've had a solution for this, but our margins have been shrinking so steadily over the past 2 decades, almost 25 years. There's been a steady decline in margins. And that has consumed us to the point where we haven't been paying attention to the causes. This is like, what's the proverb about, quit, after you've pulled the 5th person out of the river, maybe you should go upstream and find out why they're falling in. Well, that's where we're at now. Let's find out why our margins have been falling, and let's fix that so that we can go forward and be more healthy. And that's what we've done for the past 2 years. So more than ever, you, the stakeholder, need to focus on becoming an investment grade company, a company that someone will invest in, because I'm asking you to invest in your business. So if you will invest in it, then maybe somebody else will invest in it. If you're not willing to invest in your business, you're not going to be attractive to anybody else, or to very few people. So what should you be doing right now as an owner? Well, what I want you to get out of today is just have a better understanding of the variety of exit and succession options that you might have. You can have a succession plan without having an heir, right? You can have an exit strategy without having a buyer. Okay, you need to choose a path that's best for you and be the business that can be sellable or can be transferable. I'll talk a lot about transferability. Now, intentional outcomes for yourself and for your family are important. I mean, great, you're collecting a paycheck, you're taking care of this next job. Yeah, we've got a little money in the bank, but that's not the same as an intentional outcome. That's not going to get us to the end. It's not going to answer the question, where does this stop? When is enough enough? And you can answer that question only for yourself. You might need some help to do it, but it's a question that needs to be asked. And then once you become comfortable with that answer, or as comfortable as you can be at this time, you've got to communicate so others can help. You've got to communicate to your spouse so that they can help. You've got to communicate to your partners, to your senior executives, and even to the team so that they can help you achieve your goals. In this process, you should be also rethinking the owner-operator model. Because what you're going to find is a person who operates their own business as the owner, in other words, they are working in their business, has fewer options for an exit strategy or succession plan than somebody who is actually working on their business and can remove themselves from that business if there is an eventual exit. And this is not a small distinction, and this is not something that's just age specific. This is in how you design your company. I work with some very young entrepreneurs who have very exitable businesses because they've set them up with the intention of one day being able to have execute a succession plan. You can be an old person like me and catch up. So that's what we should be thinking about today. So let's get started on some of the things that we need to understand about this. So when I say exit strategy, most people automatically think of sell my business and retire. So I grow. I decide one day that I'm going to sell my business. I look around, see if I can find a buyer. And oh yeah, I'm probably gonna have to hang around for 2 or 3 years, but I kind of planned on that. And you do the deal, and then whatever happens, happens. This is not an intentional exit strategy. This is a very much traditional accidental exit strategy, which is the one that most business owners, most small business owners have in the back of the head as their plan. All of my clients know that we are going to have an exit strategy conversation very early in our engagement. Because if you don't have an exit strategy, we need to put one in place, because that helps us understand how to set up the things that we're going to do next. You know, if we're going to solve your income problem or rebuild your sales funnel, knowing what your exit strategy is going to be will affect the decisions we make about your sales funnel. It affects everything. Maybe not massively, but subtly enough that it's worth the effort of making the minor adjustments towards your exit destination in the things that you're doing today. So waking up and deciding to sell your business is not a great exit plan. Your choices are not going to be very good. And matter of fact, most people in this situation find that they're not going to get the kind of deal that they thought was going to be out there. But where does this idea come from? Where does this concept come from? And whether you're an old person like me or not, whether you were in business in the 90s or not, you've heard about it, because us old people talk about this stuff all the time, right? The go-go 90s. 90s was the decade of irrational investment. We were rolling up companies, businesses were trying to go public. You know, the formula was get as much revenue as you can, do an initial public offering, get a bunch of cash out of the business, go do another deal, go do another roll up. And it happened in our industry. And there were a couple of pretty major roll ups in the live event side and in the systems integration side in the 90s, both of which went belly up. Both of which were so poorly managed, so fiscally irresponsible in their execution that these companies went bankrupt. And actually, many of the owners who had sold their businesses into those organizations ended up buying them back out of bankruptcy. So what happens in that kind of irrational roll-up situation? And I dare say, you know, the company I worked for was caught up in this as well, but probably fared better than most companies. The first thing that happens is your CapEx, your capital expenditures, get cut, because to an investor, that's free cash that they're not going to be able to take out of the business. So your strategy suddenly becomes non-existent, because your business strategy, certainly back in the 90s, was get more gear, hire more people, do more shows. Well, if I can't buy more gear, I'm not going to get the people that I want, and I'm not going to get the shows that I want. Okay, so all of a sudden you're undermining the basic premise of how businesses were set up back then. All of a sudden you're struggling to compete, and you end up with, you know, for every 4 companies these roll-ups bought, they ended up with the value of 3 companies, probably less. So, you know, the ideal formula in a merger or an acquisition is 1 + 1 = 3. That's what you're looking for. That's a strategic acquisition. That's something that would make sense. But when you're doing 1 + 1 = 1.5, there's something fundamentally wrong. And this is what we saw in the go-go 90s. So that's not the era that we're in now. And this is certainly, while we're seeing roll-ups now, we're seeing something very, very different going on. And it's great. It's very positive. And it means that you have a lot more options for exit strategies than you had before. Now, especially in our soon-to-be post-pandemic era, most of you have much less overhead than you had before relative to the amount of revenue that you're doing. Your profits are higher, your gross profits are much, much higher, your overhead's down, your net profits through the roof. You're spending less CapEx. I mean, you're just buying LED walls because they're on every job now. But other than that, you're not having to spend as much money on gear as you did before. And you have a model that is a little bit more scalable. So it has to be a pretty horrible month for you to lose money, right? Instead of having, maybe 6 good months of the year and 6 months where you lose money, you got 10 or 11 good months and maybe 1 month where you struggle. So it's a much better situation for managing your business, which means you're going to have more opportunities. Our organizations are better rounded than they were before, than even 2 years ago, but certainly than 5 years ago. We now have branding and marketing. Most of you have a marketing person who are engaged a marketing company to help improve your brand image and your customer communications and how you look to the outside world. You're adding outreach. You have executive teams that are better rounded. Your teams are smaller. So if you kept all the people at the top, you got a pretty good sized brain trust, but you don't have a lot of the expensive overhead because you're outsourcing more of that, which you can do because you've got this brain trust of people to run a better organization. So you look more like the organizations that investors are used to seeing and less like an industry that was unique, therefore unfathomable. Investment horizons have increased. The 90s, the investment horizon was, 2 years. We want to go roll up in 2 years, go public, get out in 2 more years. Now we're looking at investment horizons in private equity, which some are as long as 8 and 10 years. Some investment funds are in perpetuity. They're going to stay in, that fund is going to exist as long as it makes sense for the shareholders in the fund. So it's a much more practical way of looking at business. Private equity is much more involved in adding value to businesses than they were back then, where they seem to be mostly extracting value from businesses, from my personal experience. So this is all good. This is great news. And there's much more transparency and responsibility. So when companies are having talks with investors or investors are having talk with companies, there's a lot more transparency about what we're actually looking for. It's less about here's the promises that we're going to make versus as opposed to here's how we work. Here's how we both succeed. And that's great for you, right? It's, it's much easier to trust somebody who's open book, and it's much easier to turn over the reins or create a new avenue for your employees if you're confident in who you're dealing with. So this is a much different environment. It's much more positive. So what are some of the options for you as owners? And again, I remind you, anytime you have a question, pop it in the Q&A. I'll find the appropriate time to answer it. But owner exit options. The option that most people take is they didn't do anything. Right? They remain the owner operator. It's what 90% of you are going to do. It's what you're comfortable with, and that's fine. But if you're part of that 10% that wants to do something else, you have other options. The next most prevalent option in terms of the 10% who take an active role is the retire in place model. I call it the annuity model. Get your business set up to run on its own, get the right management team in place, check on things from your villa in France, or from your boat, and make sure things are going okay. And take your draws, maybe take a consulting salary, whatever it may be, but you remain the owner, and you have the options of moving succession plans, right? There's and I'll go into each of these a little bit more. There's the merging into a growth opportunity, and what we're seeing right now are basically stock swaps, where you take, the assessment, the valuation of your business in comparison to the valuation of the company that is going to acquire you, and you trade for some stock and you get together and you hope what you're looking for again is that 2 + 2 = 5, 1 + 1 = 3 model, where your valuation instantly increases once you become part of this larger organization. And that in turn will acquire more companies and the value of your shares will continue to increase. So there's a model out there for that. There is the traditional sale. There is still that model out there where you can engage with a broker or respond to an inquiry and sell your business with some sort of an earnout or a consulting period where you stay on while the business transfers, where there's some post-sale guarantees. That model is still out there. It's the one that we hear about the most because we see it. You see a change in hands, you see an announcement, you get a press release. These are the ones that we know about. So we think it happens more often than it does. But in fact, a lot of the other options happen in the background and you don't hear about them. So that traditional sale model is still out there and it's still a viable option for many of you. And then the third option, or the last option, is becoming your own roll-up, becoming the anchor, becoming the bank for a company that is going to grow and then sell on. And it's part of the journey into an exit where you're finally going to sell the business. But the journey there is a little bit different. So, you know, one owner described it to me, I'd rather be the windshield than the fly. And they want to anchor their own roll up because then they're the windshield. And that's fine. It's a matter of your taste, your preference, your tolerance for risk, your access to capital, and what you majored in college, because this is high finance and it's not for the weak of heart. Trust me. Even with my MBA, I would be a little bit uncomfortable with this without having some really strong financial backers to help me get through this piece of it. But let's look at these a little bit more closely. You know, the work until you can't work anymore, which in my interviews with owners is typically what most exit plans are currently, is I'm just going to keep working. I've got to get through these shows next month and then maybe I'll think about it, but I'm just going to keep working. And it's great. You know, you can avoid risk and you're going to avoid innovation because you don't really have time for it. There's the downside of it, kind of leaves your employees in limbo. When employees are asking for strategy and they're eager to do something and you just don't feel like getting involved, they read that lethargy. And it's very often because that owner doesn't have an exit strategy, doesn't know where they're going next, and just wants to keep things going long enough that they can collect a paycheck and let their estate handle the burden that they're going to leave behind. And I know it's a burden. You may not think it's going to burden. You may think it's going to be okay. I'm one of the people who gets the phone call from the grieving spouse or their attorney to say, what do we do with this business? You know, the owner died. Yeah, great. He was on show deck on headset and he died during the middle of a show. He died happy. But the fact is he's dead and we have a business we don't know how to operate. And that's not what you want to leave behind. It's much harder on them than you could possibly imagine. So do what you can to come up with an exit strategy. Which here's the place to start. Why not the retire in place model? Retire in place is great because, you know, you can develop the teams and processes that are going to help you retire. It's what most of you ask me for when you call. How do I make this work? Okay, I can, you know, if we can get all these processes defined and get the team sorted out and make sure I have the right people, you know, then the business is going to continue to operate. And eventually I could work less. And that's kind of the goal, right? So, but I will tell you that retire in place is a little bit more intentional than just finding a good general manager who can do things for you, right? What you're going to do typically in a retire in place model is you're going to replace all the roles in your business that you have been having. If you're in sales, you need to get out of sales. If you're in operations, you need to get out of operations. Effectively, you're going to become your own board of directors, even to the point where some of my clients do form a board of directors, bring in some of their friends and advisors, other business owners, maybe legal counsel, maybe their longtime CPA, to help be advisors from a board level to help keep the management team on track and accountable through actual reporting. That's the things that most small businesses never get around to doing, sitting down with the management team, looking at the P&L report and the results from last month and saying, why did this happen? And what are you going to do to prevent it from happening in the future? Or why did this happen? What can we do to make it happen more often? Those kinds of intentional management techniques that larger companies use are available to small companies, but we don't always use them. In the rod, tire, and place model, this suddenly becomes very, very important for you. Now, in doing this, you're effectively creating a sellable business. You're just not going through the efforts of pursuing a sale. That doesn't mean that a sale might not fall on your lap one day, but if it does, look at you. You're prepared. You've got a management team in place. You've got processes in place. You've got accountability, all the parts and pieces there. And if the right buyer came along, then you might have a conversation with them without thinking, oh, I'm not ready yet. We need to fix all these things first. I don't think I can get the money I want to get out of it until I get this thing fixed or this thing done, which is often what I hear. So we see this, where we see this most often, one of my favorite examples, of course, is always restaurants. Look at a successful restaurant model. If they open up one restaurant and get it working, they can take that and go put in the exact same restaurant in another part of town, make maybe a few tweaks to the decor for the neighborhood that it's in, build a new team, transfer all the processes, the menu and everything, increase their buying power, right? Increase their training opportunities, and then they go open the third one. Okay. What you won't find in most successful restaurants, unless it's a owner-operated, chef-owned restaurant, is the owner. You don't find the owner in the restaurant that often, unless they drop in on a Friday night to stop by a few tables and talk to a few regulars before they go to the other restaurant, and then the other one and the other one. So we see this model all the time in businesses, and you can effectively do the same thing by putting the right management team, having the right processes in place. Okay. Now, it's harder than it looks because you do have to trust someone to run the business, and that person is always going to cost you more and expect more of you than what you think you want right now. So you have to stay connected, verify they're running it well, but trust me, the model does work. Now, the merger options, if you want to merge into a larger organization and use that opportunity to increase the value through the merger process and becoming part of something bigger that will eventually sell, you have to do a lot of the same things, right? You have to take steps right now to improve your valuation. Okay, I'm going to give you a list here at the end of this of questions that you need to be asking yourself about so you understand what you need to improve in your organization right now. So, but at the very least, you need very consistent financial returns, not the peaks and valleys that we saw before the pandemic. We need an overall positive trajectory. I need to be able to look at trailing 12 months reports and see them extrapolated out for the next 12 months and see a line that's going up where it's supposed to go up and going down where it's supposed to go down. In a merger option, you're probably going to remain an employee of the business. That's part of what's going to make it work. It's not always true, but it's most likely true in this kind of scenario. But the more transferable your business, the bigger your post-merger role. Think about that. So if you want to go into a post-merger situation at a C-level role in a major corporation, then you better have your act together so that you have a path to that. Otherwise, what you're going to find is you're going to be the general manager of a branch, and you're going to have a boss, and you didn't have a boss before, which is not always the fun that you think it will be. So oversight is what's going to happen after a merger. You're going to have new bosses, going to be looking at your financials, questioning your processes, but they're also going to be going, hey, can we take that process and put it into this division or in this group or in this city's operation over here? And so there's a lot of fun things that can happen after a merger if it's a well-run organization, which of course it will be because you will have done your due diligence and vetted them out. Now, traditional sale, the challenge here is that very often this opportunity appears out of the blue. It's not, you probably get a call right now, every other week, if not every week, from a business broker who's just, twisting the doorknobs and see if he can find a door that's unlocked for somebody who's ready to exit their business. And these are salespeople. These are not people with buyers. You know they don't have a buyer. You know they don't know anything about your business. You know they barely looked at your website. But someday you may actually get a call from somebody who seems to have done their homework, and you're going to listen, and you're going to lean in a little bit and say, tell me more. Someday you may find a broker who actually has a buyer who's looking for businesses like you. So more of the puzzle pieces fit together. Unfortunately, you probably haven't done anything to get ready, which means it's difficult or it's uncomfortable for you to take advantage of that situation. But in a traditional sale, you're going to sell to a new owner operator. So you're going to assist with the transition. It may be short, it may be a little bit longer, or the owner operator is going to come in and operate, and you become an outside advisor for a very short period. Basically, somebody else wants to take over your business. And we see this a lot in other industries. Every, company that does security installation is for sale, and somebody else who wants to do security installation will buy it. Restaurants, of course, sell this way. Lots of small businesses sell this way. They take that business, new owner comes in, takes that business, and decides to do whatever they want to do with it. Okay. Now, you still need to be attractive. You still need to be working on your business to make this work and to be ready for this to happen. But I will tell you, these transactions are probably the messiest that I see. And seller's remorse is very, very common. When you're working in the business after you have sold it to a new owner operator who has different ideas about how to do things, you have this triangular conflict between your old employees, which are now their employees, and your traditions and your history. And it's not always a comfortable way of doing things. So these are what I find to be the most problematic, but they can work if you are better prepared and if you do your due diligence with those buyers. And then the last option I talked about, of course, was becoming an investor, basically you becoming the bank. If you work in your business right now, if you have a single account with your name on, if you're one of the people that has to go out on job site when you're busy, you're not in a position to do this, okay? You're in a position to do this if your primary role is to oversee the finances of the business and you've got a team that's taking care of everything else. If you are not the customer, the person who is primarily customer facing, all you have to do is swoop in and shake the hands like the restaurant owner who swings by on Friday night and sees the regulars. If you're that person, then if you've got the savvy and if you have the backing and if you've got the stomach and the risk, the tolerance for risk, you go out and find companies to acquire. And as you know, it's much more interesting to talk to somebody who's in your business, right? Already they're in the industry because they understand your industry, and you would rather sell to somebody who understands your business than somebody who doesn't understand your business. So you add an advantage in a roll-up if you're from the industry, whether you are the financial backer or not. If you're the face of that roll-up, you're going to do a better job of finding companies that fit. So this is an interim step. Again, this is the bigger is better model. Is what can we do to make it bigger? There's a lot of traffic and noise out there. If you want to acquire market share and get out of being the yet another $8 to $10 million company and become the $40 to $50 million company so that you can become the $100 to $200 million company, this is the quick path to doing that, okay? You will also probably look at things like consolidating some of your supply chain, right? You might buy companies that have been your suppliers because they're going to fulfill for a larger organization. You're going to bring that skill set and talent in-house. It's going to wreck the rest of their business. They're no longer going to have your competitors as customers, but it's another way of growing the business and scaling up fast. So there's a lot of interesting things that can happen in that model. But here's the question you should be asking. Is your business transferable? Okay. So start thinking about that for a second. Let me check this question real here. Should you get a valuation of your business before going through any of these processes? Yes, getting a valuation of your business, and you can spend several $1,000s getting a valuation. But you should be able to do a valuation of your business first so that you have an idea of what that valuation is saying. And if you don't have that, getting an official value, there's no such thing as an official valuation because ultimately it's the buyer who decides. If you go to a broker to get a valuation, the valuation is going to be high because they want you to sell your business so that they can talk you into taking the offer so that they can get their commission. And I'm not completely down on brokers. Actually, some of my best friends are business brokers in the industry, but the fact of the matter is it's in their best interest to sell your business, not to maximize the money that you get for it. So look at where you're getting your valuation from. Getting a valuation from somebody who's not familiar with the industry means they may look at the wrong metrics, may not have a good idea. I will tell you right now, it is very difficult to get an educated valuation other than looking at the financial metrics. And if you're selling to private equity, that's probably all they're going to look at anyway. But you probably don't want to sell to somebody who doesn't understand your industry and what the numbers mean. And I've got some clients that are going through this right now. They have people looking at their numbers going, well, wait a minute, you had a horrible 2020 and I don't trust your 2021 numbers because they're so different from 2020 numbers. And it's like, hello, folks. We know I can right now, if I'm looking at your 2021 numbers, that's all I really care about. I don't care about your 2020. I don't even care about your 2019 numbers because that was a different era. So you want somebody doing evaluation who understands that. There's more to talk about in terms of valuation, which I'm not going to go into this webinar, but those of you who have questions, you know how to reach out to me and we can talk about that offline. Now, here's a quick checklist for you to go through. You know, you took the time to be on this webinar. What should you be thinking about next? One slide, but I'm going to have a lot to talk about here. Okay. So here are 10 questions that you know, if I'm assessing a company, if I'm going to help do the napkin valuation, and so I'm not going to do an official valuation for anybody, but I will do a napkin valuation. Here are the types of questions that we're going to ask. If I get hired to do due diligence, these are questions that they're asking me to verify what they think the answers are. So how diverse is your customer base? Many of you are telling me that, hey, I'm a little uncomfortable right now. I have one client that's 80% of my business. That can be a good thing and that can be a bad thing, okay? Knowing what it is and how to leverage it is something that can help or hinder your valuation. So knowing the diversity, just regularly looking at those reports, making adjustments when it makes sense for you to do that, to get a little bit of balance in there. But you know, having a customer list, which is 100% pharmaceutical, could be fantastic if your buyer is a strategic buyer who wants to increase their footprint in the pharmaceutical space. It would be horrible if somebody's trying to get a well-diversified business that's going to survive the up and downs of the economy, right? So understand your diversity. Is your revenue stream sustainable? Many of you tell me right now, you can't forecast. Well, you're not going to be able to convince anybody that your revenue stream is sustainable. Past history is not proof of future results if you can't predict and don't have a track record of successful prediction. So learning how to predict and forecast is very important in making your business transferable. Even if the news is bad, being accurate is more valuable than somebody who simply is surprised that they had a horrible March and they thought they'd be busy, right? Value proposition. I remember during the due diligence process back in the 90s when the company I was working for was being sold and I was in the boardroom answering questions. Basically, I was in the hot seat for my role and the lead person was grilling me. I was sweating. He was grilling me on, you know, how do we win business? He basically was asking what our value proposition was. And our value proposition was that we could get a quote out faster than anybody. And we were the first to quote on every major job because producers came to us because they needed numbers now and we gave them the numbers. Their other suppliers took days, even weeks to get numbers out to them. And so that was our competitive advantage. And our value proposition was that we could help them to win business by giving the numbers that they could confidently go forward and do that with. But so basically he interpreted that as, oh, so you're a proposal mill. It's like, did you not hear anything that I just said? Okay. We're not just shotgunning proposals. Okay. We don't write a proposal for anyone, but when a proposal opportunity is there, we're first to market. So understand what your value proposition is and what makes it distinctive and how that can be leveraged into more business and better business is very important in this process. GAAP financials. I review financials all the time. I'm reviewing financials today. My nose is in spreadsheets. Most people are GAAP compliant because that's where the accountants, particularly in the US, are all trained with these principles. But they don't all follow them the same way. And a lot of them take input from you, the owner, about where you want your numbers. Sometimes where you want your numbers does not make sense to anybody on the outside looking at your business, trying to compare that with other businesses. So GAAP compliant is pretty important. Audited, if your business is $8 million or more, you should be audited. You should pay to have your business audited, make sure your financials are accurate. If you're 15 or $20 million or bigger, you should be audited probably every year. This credibility makes it much easier for somebody looking at you to quickly be confident in what you're telling them. So you don't need to be audited, but you do need to be use generally accepted accounting principles in your business. And you need to have financial statements that make sense to people who look at financial statements, not just make sense to you. Does reviewing your financials help you make better decisions? Do you guys look, does your team look at them? If you see something that's different, does it affect behavior? Are you asking any questions about that? This is very important. So if you're looking at your financials and not acting on them, or you're just all nodding and smiling, go, "Oh, that was great," or, "Oh, gee, that really wasn't that good," but you're not changing anything, it's not actionable, that's going to be a concern. And in the due diligence process, if we see nothing happening on financials, well, I might know that, hey, if I can get this company for the right number, there's probably a lot of improvements I can make to the organization. But that may not be where you want the value to fall. So knowing how to use your financials is important. And these are in no particular order, by the way, but can your business run without you? Can you take a 3-week vacation? Can you take a 3-week vacation and turn off your phone? When you come back, is the organization still healthy and running? Okay. And you have to be honest about this, because if you can't, if this is a challenge for you, it's going to be a challenge for your buyer, and it's going to change the options or limit the options that you have for how you exit the business. So if you're helping to sell and retire, and be out in 2 years, I just want a 2-year agreement and I am out of here. Well, guess what you're going to spend 2 years doing? You're going to spend 2 years trying to hire your replacement, which if you had beforehand, probably would have added another digit to your multiple when you sold the business. So getting your business to run without you should be a goal. Not everyone can do it. Not every size of company can do this. If you're a $2 million company with 8 employees, it's going to be difficult for that business to run without you. You want to get it to the point where you can, and you will have more options. It doesn't mean you're not sellable. It just means that you're only sellable within a certain parameter of options. The next two are very important because they fit together. When you do more business, when you have a windfall of income, do you make more money as a percentage of revenue? Most of you, and I've got a lot of experience with this, do not. In fact, that extra windfall business comes in at a lower profit margin than the business you've done before. The corollary to this is, as a percentage of revenue, does your overhead decrease as your revenue increases? What this means that if your revenue increases, does my overhead hold steady, meaning that percentage of revenue is lower. If it was at 20% here, it might be at 18% when your revenue goes to here. Okay, these are scalability issues. Okay, and your business does need to be scalable. If it is not, if your overhead has to increase when your business increases and everything moves like this, there's no way for investors, which includes you, to make more money by growing the business. All you do is work harder and have more stress and assume more risk. So these are two very important things for you to pay attention to. Going back to that, my experience in the due diligence 25 years ago, can you add valuable revenue if you choose to? Most of you will say, I'm adding revenue as fast as I can. We're saying yes to everything we can. That's not trajectory. Okay, that's that old answering the phone. What's your marketing plan? Well, we answer the phone, we return emails, we write quotes. We have lots of referrals, is what you say. That's not intentional revenue stimulation. Can you intentionally stimulate revenue? Can you do things that will get you the kind? You may not want more revenue. And honestly, many of you don't right now because you have limited capacity and you want to grow at a controlled pace and add resources and processes as you're growing. So you may not be eager to run out there and try and win more business, but do you know how to? Have you done it before? Do you have the systems and processes available if you chose to do that? And that's a valuable question. I know that at the time when our company was first sold, we wanted the cash injection. We knew how to get more revenue. We knew how to do all of these things. We were excited to have financial backers at a larger level who are willing to invest and grow. We were thrilled to have, sister companies who also had customers who could use what we did for their events. So we knew how to add valuable revenue if we were given that opportunity. So I think that was a lot of the value of that business. And then the last thing here is, can your employees explain exactly how and why your business works to an outsider? Can you take your managers and put them in front of somebody like me or somebody, a due diligence auditor from a financial services company or a private equity investor, and answer the questions like this and be credible? Okay. So you need management that can do this. And again, you've got to be a certain size to have the kind of management available to do this, but that's your goal. So if the more people you have who can answer these questions, the more options you have about how you can sell your business, right? So we can't flip a switch. We can't make all of this happen overnight. There are things in here that a $2 million company is not going to achieve, and that's okay. Okay, there's nothing wrong with being a $2 million company as long as it's giving you the life that you want, it's making the money you want, and it is transferable. Its transfer options and its valuation options may not be the same as a $30 million company that has a huge management team of very experienced people. Okay? They're just different things, right? So how transferable is your business? Question that you should be asking yourself all the time, because your number one job is to be sellable, right? Always be sellable. Right? So your business is going to run more smoothly if you're sellable. You're going to be more responsive to opportunity, and it's going to take less of your time, because just because you're the owner doesn't mean that you need to be immersed in the business every waking hour and most of your sleeping hours. So here's some recommendations, and then I'm going to try and answer some more questions because I think we've still got time. Yeah, answer some more questions. Some recommendations. Whatever size you are, at whatever state you're in terms of your sellability, you probably need to hire some folks, and you probably need to hire higher level skills than you think you need. The advantage of hiring somebody who is overqualified in a management position is that they're going to have higher expectations. Getting someone who came from a larger organization to come into your organization is going to pull your organization up, because that person is going to be impatient. They know what to expect, and they already know how to do it, and they're going to get you there faster. This may also mean hiring somebody who's better than you are as the owner. Just because you're the owner doesn't mean you need to be the smartest person in the room. Okay. The smartest person in the room is the one who hired the people who are allowed to be smarter than they are. So create that upward pull for yourself by bringing in talent at, who cares if they cost, 20% more than what you think you should hire someone for, if they can bring you that much more business and create that much more profitability, and vis-a-vis this webinar, make you more sellable. Okay. Whenever you can, replace yourself anytime that you can hire the talent and put processes in place so that it demands less of your time. Okay. Owners who are the pivot for everything has to go through the owner, are problematic. Owners who don't extract themselves once the processes are in place are also problematic. So figure out how to replace yourself. I've talked about, anybody have been to my workshops, talked about my dad and what I learned about business, watching my dad move up through the ranks in corporate America, coming, from a manager job to a director job to a vice president job to a senior vice president job to being considered to take over the company. And I asked him, what is he doing to get promoted? And he says, every time I get a new role, I look at the team, I figure out who's going to replace me, and I work myself out of a job. And if I can work myself out of a job and have a person who's less expensive replace me, I can go to my boss and say, okay, this is all under control. I have my replacement. They're less expensive. What do you have for me now? That's what you need to be doing as the owner of your business, replacing yourself on jobs with somebody who can do the job for less money than you are, right? Now you can also be focusing on how you look from the outside. And this is not just about marketing, and though brand and position is a huge piece of this, this is also about being seen. So how you look from the outside is, where is the owner? If the owner is unloading the truck, that may look great and it may be a great anecdote and a great story, but it may also affect your position and your value as a business to an outsider looking at you. All of this is to say, and I'm an old gigger, my recommendation is if you hope to execute an exit strategy, you need to be working on the things that will get you there, which means that you're going to have to stop gigging. And as you make the improvements in your business, don't go back to gigging, take that time for yourself and start living. Because if, like 90% of the people, you choose to just stay with your business and continue to work it or treat it as an annuity or retire in place, living is what it's all about. And the sooner you start living, the more successful you will look and feel to everyone around you. And, that's another way of keeping score, isn't it? So, I'd rather buy a business from a successful entrepreneur than a failure. Look like a successful entrepreneur, buy a bigger boat if that's what floats your boat, because that is part of the game. So I will take whatever questions you guys have for me right here. I'm going to turn off the share and you can just look at my bigger face here right now. Let me see. Go back and check the questions here. Yeah, I did the Gordon Gekko reference. Matter of fact, I had an entire slide, which I chose not to show you with the Wall Street theme on it. By the way, one of the best movies to talk about the go-go 90s is watch the movie, the original Wall Street movie, and then watch the movie Other People's Money. These are great. This is a great help you understand the finance of that era. And then watch the movie about Enron. What's it called? The Smartest Guys in the Room. Watch that movie. And when I started graduate school to get my MBA, Enron was the darling company of Wall Street. My managerial accounting professor was friends with the CEO, an advisor to the board. By the time I was graduating from graduate school, all of those people were in jail. It's a great story. It's a great lesson to be learned. Good book too, by the way. I read the book. All right, questions here. Okay. When do I tell employees? Okay. Tell them what? Tell them that you hope that you expect to sell your business one day. Well, the fact of the matter is they probably already know. But it doesn't hurt to be open about that. The question that this is normally in front of is, I've got an offer letter. I'm looking at selling the business or in talks. When do I tell my employees? And the short answer, the quick rule of thumb is when you have a letter of intent, which means there are parameters put in front of you on the conditions upon which the buyer would buy your company. And after that point, it becomes a negotiation, which then leads to due diligence, which then leads to a final contract, which then leads to closing. When you have a letter of intent, that's when I would tell my senior management. Okay. When I have a closing date, that's when I tell my employees. But right now, I can come into my office tomorrow morning and say, guys, we need to do a better job of making this business franchisable, okay, sellable. I have no plans on selling it. Okay. But I need to have a business that is sellable, because the things that are going to make it sellable are the things that are going to help us make money, help keep you in salary, help keep us in benefits, help us to grow, help us to get better clients. All the things that we want to do go hand in hand with being a sellable business. So we're going to do those things. And oh, by the way, not to be sellable, but the byproduct of all those things is going to make us sellable. So let's work on that. And then let's keep growing. and then I won't want to sell, and that'll be fun. If we're making money and having fun, or making money and making a profit, we're going to have fun. So let's have some fun together. And that's what I would tell them. But I err on the side of transparency. And for the employees that are uncomfortable with that, they're going to have to sort that out. But not everybody is going to be a great employee for you in the long run. Not everybody works well in that kind of environment. But yeah, do tell them that, yeah, you're not in this forever. You're not going to live forever. And here's what's going to happen, and here's how they can help, and how could they be part of it. All right. Questions. I was poised to retire pre-pandemic. A lot of us were. My son's ready to take over the company. Now entering a time of more normalcy, we want to reopen the conversation. Is evaluation still appropriate? Yeah. So how do I ever realize the equity I've earned over the 30 plus years? You've been taking equity out of your business for 30 plus years. So trust me on this. If you go look at your balance sheet, look at your retained earnings. If your retained earnings after 30 years isn't $20 million, you've already taken all the equity out along the way, and that's fine and that's normal. So don't kid yourself. You've done something with this money. But in terms of succession, when it is a family member, I recommend that you still treat it like a sale. It is still a sale, so you still need to do evaluation. It's very typical, and it's certainly not unusual, for a parent and a child to strike a deal based on a valuation of the business, where over time, the buyer, that is the heir, is buying off the loan, and basically, you can be the bank for your child, and you're going to carry the note and hold the loan, so that they have to pay off a loan. But they don't have to go to a bank. They don't have to go SBA. You can become the bank. And that's just one way of doing it. It's very common. You can simply start willing or deeding over shares. There are all sorts of tax considerations to be had on this. I'm not a tax advisor, but talk to your tax advisor about how to do that, about transferring shares over time to minimize the tax hit, that sort of thing. So yes, evaluation is always going to be appropriate. And if you're going to write a contract, even if it's with your child or your heir or a close friend, having a valuation, paying for a valuation to go into that contract as the basis for your conversation is a good idea. Great question. Next question. How many people are valuing companies based on EBITDA multiples? If not now, future earnings? All right, so buyers buy on past earnings, sellers sell on future earnings, okay? EBITDA is still a viable multiple. What comes into play is the sensitivity about CapEx. For instance, 3 years ago, if you tried to sell your company, and if you're a $10 million company and you were spending $1 million a year on new equipment, which means you had about 8% depreciation every year on a 5-year depreciation plan, your EBITDA would be valued against your CapEx. So if your EBITDA was 1.5 million, they would subtract $1 million of CapEx that you took out of that. And now your EBITDA is only $500,000, which is basically called a free cash flow calculation, which says how much cash can this business throw off? Well, your business can only throw off $500,000 worth of cash because, and you said this, you have to spend the $1 million or you can't do the business that you're in. So the $1 million CapEx investment wasn't optional. Therefore, our valuations would be lowered. What's exciting about our time right now is that we're still in EBITDA calculations, but our CapEx demands are lower. Okay, they aren't going to be as consistently high. You may have a peak year, but over time, the number is going to be much, much lower, which means that they're less likely to add in all the CapEx to reduce your calculated EBITDA. At any rate, your EBITDA number is always going to be an adjusted EBITDA number. The buyer is going to make adjustments based on how they would run the business. Sometimes they're going to do that in collaboration with you. Sometimes they are going to do it outside of that if they think it's to your advantage. If you're overpaying yourself, well, you want to remove that money from the EBITDA, from your numbers, and put it back into profit because you're overpaying yourself. Another operator might have a person making less money than you in that role. So we have add backs and add ins. So there's a whole lot of things going on, but EBITDA is still a very important. The biggest component of EBITDA is net profit. 2% net profit ain't going to get you a lot of valuation. So you need to be looking at your 15 and 20% net profit if you want to get some real decent money out of your sale. So how do you recruit successors? Well, you don't necessarily recruit successors, but you may have people in your business. So when we talk about succession, we're either talking about family members, heirs that we're going to will something to. We talk about often employees or management buyout within the organization. Typically, they're easy to recruit if you're going to be the bank. If you go to your employees and say, hey, I'd like to sell you the company and I'll finance it for you. You just need to write me a check for $200,000 every year for the next 10 years and we're good to go. You can make that deal and that's you finding your own buyer. Otherwise, successors will typically come to you saying, man, you've really checked out. We'd like to buy your business and we don't want to pay you very much money because you haven't put much into it lately. We're doing all the work. So there's a double-edged sword in all of that. So I hope that answered your question. Next question, what is the relationship between debt and sellability? Debt is reconciled at sale. So when somebody's valuing your company and they say, hey, your company's worth $8 million, but you got $6 million worth of debt, here's a check for $2 million. It's not exactly how it happens, but that's basically what happens. If they're doing an asset purchase, it's your job to settle the debt. So they could take on the debt in an equity purchase, but that debt is going to come out of the selling, the buying price. So it does get reconciled. Debt is not necessarily a bad thing. The ability to service the debt is what's important. So if you can service your debt consistently, debt's not necessarily a liability. Sometimes lack of debt can be a big asset, but sometimes it's also a deterrent. So I think a little bit of debt is good. It makes the conversation a lot more interesting. It shows that you're investing back into the business, which means I have more trust in the credibility of the future earnings, to go back to the earlier question, of your business, because I see what you're doing to ensure that you get those future earnings, which is how you are valuing your business, about the potential earnings, because you're comparing an offer to sell your business to what you could earn from it in the future, right? So it's got to be worth your while to give up those future earnings. So, all right, guys, folks, this has been a fantastic webinar. I've enjoyed sharing this with you. I haven't gotten to talk about this stuff as much as I like to, and thank you for doing that with me. If you have more questions, if you're the owner of the business, reach out to me. I do have an opportunity for you to go deeper into this in a workshop that we're going to have later on in just a couple of months, but you need to contact me personally about that, and I will tell you about and see if that's a good fit for you, and we can go deeper into these things and help maybe get you on the trajectory of having a sellable business and meeting other owners in the same position that you're in. So there's that opportunity out there. So thank you, everybody, for being here. The recording will be up later. Good luck. Have a great time.